Silver soars overnight, doubling in value on a Thursday in 1980. You wake up to news that silver prices have nearly doubled overnight. The previous day saw an extraordinary surge, with prices jumping from around $6.50 per ounce to over $13. But today is different. Today, the price of silver hits new peaks and then collapses dramatically. This is Silver Thursday. On January 21, 1980, something incredible happened in the commodities market. The price of silver surged dramatically before crashing, leaving chaos and confusion in its wake. This event is often referred to as Silver Thursday. Let's dive into what exactly caused this event and why it matters today. You've probably heard about stock market crashes like Black Monday or Black Tuesday. But did you know there was a major crash in the commodities market as well? Silver Thursday, which occurred on March 27, 1980, was one of those moments that changed everything for investors and traders. The price of silver soared from around $5 to over $49 an ounce within just a few hours, and then plummeted back down. To understand what happened, we need to look at the broader economic context of 1973. Inflation was soaring, reaching around 8% that year. This made commodities like gold and silver appealing as inflation hedges. People started buying these metals because they believed their value would hold up better than paper money. One key player in this drama was a man named Nelson Bunker Hunt. He was part of a wealthy family known for their oil fortune. The Hunts were significant players in the commodities market and saw silver as an investment opportunity. They began accumulating massive amounts of silver through futures contracts, which drove prices higher. Futures contracts are agreements to buy or sell something at a future date at a price agreed upon today. In this case, the Hunts were buying up large numbers of these contracts, effectively cornering the market. By January 1975, they controlled about half of all outstanding silver futures contracts. As Hunt continued his aggressive purchases, the supply of available silver in the spot market, meaning immediate delivery, became scarce. This scarcity made it more difficult for other buyers to acquire physical silver at affordable prices, driving up the price further. But here's where things got tricky. When you buy futures contracts, especially in large quantities, there's always a risk that prices could drop suddenly. That's exactly what happened on Silver Thursday, also known as Silver Tuesday, which occurred on January 24, 1980. Hunt and others had borrowed heavily to fund their silver purchases, creating massive leverage. As soon as the price started falling, they faced margin calls from lenders demanding more collateral. The domino effect was immediate. With demand for physical silver exceeding supply, speculators began to panic sell futures contracts to cover their losses. This flood of selling caused prices to plummet dramatically and almost instantly. Silver futures prices dropped from a peak of over $50 an ounce back down below $14 within hours on March 27, 1980, now known as Silver Thursday. So why does this matter today? The 1980 silver crisis, often referred to as Silver Thursday, is a classic example of how the commodities market can be manipulated by powerful players, leading to extreme price volatility. This event highlighted key issues in market regulation and the risks associated with leveraging bets on commodity prices. For starters, it highlighted the dangers of unchecked speculation. When large investors like the Hunt brothers buy up massive quantities of futures contracts, it can disrupt normal trading patterns and drive prices far above their intrinsic value. This kind of market manipulation has real-world consequences for producers, consumers, and speculators alike. Another lesson is about market oversight. In the aftermath of Silver Thursday, which occurred on March 25, 1980, regulators took steps to prevent similar events from happening again. They introduced measures like position limits on how much any single trader could control in certain markets. This helps reduce the risk of one person or entity having too much power over prices. But despite these efforts, commodity markets remain susceptible to sudden shifts and speculative bubbles. Today's investors need to understand that commodities can be volatile and require careful risk management. While there's no magic formula to avoid every market downturn, being aware of historical patterns can help in making informed investment decisions. Let's take a closer look at the mechanics behind Silver Thursday. How could prices swing so wildly? It all comes down to supply and demand dynamics, amplified by speculative buying and selling. When the Hunt brothers' aggressive purchases dried up available silver supplies, it created a situation where small changes in perceived scarcity could lead to significant price swings. Now imagine you're holding onto your own futures contracts as the price drops. You might start worrying about margin calls from your broker, which require you to deposit more money or sell some of your positions to meet the required balance. The pressure to sell becomes intense, leading to a rapid collapse in prices. This kind of behavior is not unique to silver. It can happen with any commodity or asset class if trading conditions are right for speculation. But there's another critical factor: leverage. Leverage amplifies both gains and losses. When investors like the Hunt brothers borrow heavily to finance their bets on rising prices, a small dip in the market can trigger significant financial consequences. This is why leveraged investments always carry higher risks compared to unlevered positions. To understand this better, let's break it down into steps. 1. Hunt's aggressive buying. He purchases large amounts of silver futures contracts in an attempt to corner the market. 2. Supply shortage. Physical silver becomes scarce as speculators hoard available supplies to drive up prices. 3. Price surge. The shortage causes prices to rise dramatically, reaching unprecedented highs. 4. Speculative selling. As price drops occur and traders realize they cannot meet margin calls or face significant losses, many rush to sell their positions. 5. Market collapse. A sudden flood of selling pressure causes rapid and dramatic declines in silver prices. Each step in this chain reaction highlights the interconnectedness of financial markets and how quickly instability can spread when speculation becomes excessive. This is why regulators often implement measures to limit speculative trading activities, aiming to protect market stability. But here's a key takeaway: even with regulation, these risks don't entirely disappear. Investors need to be cautious about leveraging their bets on commodities or any asset class. A smart strategy involves diversification and risk management. Don't put all your eggs in one basket. So let's circle back to why this matters today. The lessons from Silver Thursday are still relevant because the fundamental nature of the markets hasn't changed. Speculation, leverage, and supply-demand imbalances can still create volatile conditions that catch traders off guard. In summary, here's what you need to remember. 1. Speculative risk. High levels of speculation can drive prices far beyond their intrinsic value. 2. Regulatory oversight. Market regulation is important for maintaining stability but cannot prevent all crises. 3. Leverage dangers. Borrowing money to amplify investments increases both potential gains and losses significantly. Silver Thursday, also known as Silver Monday, was a significant event in financial history on March 13, 1980, when silver prices plummeted due to speculative trading. This crash underscored the risks associated with speculative bubbles and highlighted the importance of prudent risk management for investors. Understanding these dynamics can help you make informed decisions about your investments today. Now let's look at some concrete numbers from Silver Thursday. On July 24th, the price of silver rose to about $6 an ounce before dropping back down to around $3.80 by market close. But on August 7th, it spiked again, hitting a high of over $15 before collapsing below $6 by the end of trading. Imagine holding silver futures contracts on the morning of March 27, 1980, when their value surged dramatically before crashing later that day. This event, known as Silver Thursday, led to significant financial losses for many traders due to the extreme price volatility. So how do you protect yourself? One strategy is to diversify your portfolio across different asset classes such as stocks, bonds, and commodities. Another is to use stop-loss orders when trading, which are designed to automatically sell your positions if prices reach predetermined levels, thus potentially mitigating losses. Remember, the financial markets aren't unique to silver. Similar dynamics play out in stocks, bonds, and other asset classes as well. The key is staying informed and prepared for sudden market shifts that can occur at any time. Subject: the Silver Thursday crash. In short, Silver Thursday taught us that speculative bubbles can burst suddenly and severely, impacting even experienced traders. It's important to stay vigilant for warning signs of excessive speculation and be prepared to adjust your strategies accordingly. This leads us back to the original question: why did the Silver Thursday crash happen? It boils down to a combination of speculative buying, supply concerns, and excessive use of leverage. These factors created an environment ripe for extreme price swings. Understanding these mechanics helps you avoid similar pitfalls in your own investing decisions. To wrap up, here's the take-home message. Be cautious. High levels of speculation can lead to dramatic market movements. Diversify, spread risk across different asset classes and geographic regions. Protect yourself. Utilize tools like stop-loss orders to manage potential losses. The Silver Thursday crash, which occurred on March 27, 1980, was a stark reminder that even in regulated markets, risks exist. By staying informed and prepared, investors can navigate such challenges more effectively. This is educational and historical, not financial advice. Let's dive deeper into the mechanics behind speculative buying. Imagine investors pouring money into silver futures contracts, believing prices would continue rising. This created a bubble where the price was detached from the underlying value of silver. When some investors started selling to lock in profits, it triggered panic among others who then rushed to sell as well. Supply shortages also played a crucial role in the silver market crisis of 1979 to 1980. With industrial demand strong and production constrained by strikes and other issues, there wasn't enough physical silver to meet all the futures contracts being traded. This scarcity fueled price increases, but left sellers struggling to fulfill their obligations when prices crashed. High leverage exacerbated the situation. Many traders were using significant borrowed funds to purchase more contracts than they could afford with their own capital. As prices dropped steeply, margin calls compelled these traders to liquidate their positions by selling at any price available, thereby intensifying the downward pressure on prices and creating a vicious cycle of falling values. It's like playing Jenga with stacked blocks representing your investments. Removing just one or two can cause the entire structure to topple, especially if it was already precarious. The lesson here, always be mindful of risks associated with leveraged positions and avoid concentrating all your investment in short-term trends. Silver Thursday is also a cautionary tale about regulatory oversight. Despite being regulated, the COMEX failed to effectively address speculative activities until after the crash occurred on March 27, 1980. This highlights that even well-monitored systems can have blind spots. It underscores the importance for investors to be vigilant and watch out for signs of excessive speculation and prepare accordingly, without making specific buy or sell recommendations. By staying vigilant about these risks, diversifying your portfolio, and having protective measures in place, you're better equipped to handle volatile markets. This is educational and historical, not financial advice.